Hey everyone, welcome back to the channel. If you're new here, I'm Jazz from Sansar Solutions, and today we're tackling a biggie, sole proprietorship versus incorporating. Which one's the real MVP for your business? Grab a coffee, get comfy, and stick around because we're breaking down the pros and cons of each. By the end of this video, you'll know which path might be the best for you and your entrepreneurial dreams. Let's dive right in. On my journey in business, I remember I was about 15 years old when my mentor taught me about incorporating, and some reasons as to why one should do this, with one of the main reasons being that you would be able to limit liability. So with that being said, if your lawyer said that you need to incorporate, then it's a good idea to go ahead and do so. I know of many businesses in various industries that have gotten themselves caught up in lawsuits or defaulting on debt obligations due to unforeseen economic circumstances, and if these individuals were not incorporated, they would be held personally liable. Now, this doesn't reduce the liability to zero. It helps limit it, but there could be director's liability in the event that you, the owner, got caught committing illegal or fraudulent activity. The liability lies in the risk that you're taking with debt you may be incurring or through the products or services that you're offering. If you're unsure of what risks are involved in your business, then it's always a good idea to speak with a lawyer. One situation where it's always a good idea to incorporate is if you're building a business to sell at some point. The CRA has a specific exemption in place, which is called the lifetime capital gains exemption for up to $900,000. How exactly does this work? Well, let's say you started a business from scratch. Therefore, the company was worth zero, and then you built it to become a $900,000 enterprise, which you ultimately decided to sell. With the lifetime capital gains exemption, you would be able to receive that $900,000 tax-free. Another common scenario where getting incorporated is a good idea is if your plan is to keep retained earnings in the corporation and invest back into your business, because you can take advantage of the lower corporate tax rate versus the personal tax rate. This allows you to retain more of your capital, save it, and then invest back into your business or into stocks and bonds if you want to. You must note though that there are limits to the amount of investment income you can earn. So you want to be aware of that if you're investing through your corporation. One key to note is that you're not avoiding taxes. You're just deferring them for later, preferably when you're in a lower tax bracket. I like to have clients think of their corporation as a retirement vehicle that will earn income that is taxed at the corporate rate, but remains in the business as retained earnings that will be pulled out when they decide to retire. We must, however, keep in mind that sole proprietorships will have RRSP contribution room, which will reduce their tax liability. But that is only up to a certain amount. Therefore, once you're in a situation where the RRSP room contribution no longer provides for tax savings and tax liability, then it may be time to consider getting incorporated. Whenever clients ask us the question, they're generally asking us, how much do I need to earn in order to make it worth it for me to become incorporated from a tax savings perspective? Well, there's no magic number, as in each situation is specific to the financial requirements of the owner's lifestyle and the health of their corporation. What do the revenues look like? How much money does the owner require for personal reasons? What's the current strategy for saving for retirement? An easy scenario would be if you're earning $150,000 in your sole proprietorship, but you only require $50,000 to live. Then considering incorporating is a good idea because you won't have enough RRSP contribution room to defer the tax liability. Your corporation would earn $150,000 where you would pay the corporate tax rate, and then you take the $50,000 out personally. That's all you'll pay personal tax on, versus having to pay tax on the entire $150,000 if one was a sole proprietorship. One factor that is something that I personally considered, which was a determinant of whether I would incorporate or not, is the desire to have the business outlive me and leave a legacy, since the corporation would be its own entity. This then becomes something that you can pass on to future generations, therefore serving a purpose when it comes to estate planning. So when would we advise not to incorporate? If you run a simple business that is a low risk and tends to earn about as much as you need, or it's slightly more, however, you're able to contribute to your RRSP and reduce your tax liability for a later day, may be a scenario where you don't need to incorporate. And you can wait. Or let's say you're just starting out and perhaps there's no proof of concept yet, or the sales are not significant enough. Then waiting to incorporate may be wise. If the business model is unproven and there's uncertainty, then we advise you always wait. Many individuals have full-time jobs while starting a business on the side, and it's their employment income that generally fuels the dream of one day leaving that 9-to-5 grind. In certain situations, these startup businesses may be incurring losses, and these losses can be deducted from your personal income in the years you incur those losses, which will provide for immediate tax savings. In the event you incorporate and you incur losses, you will have to wait until the year that you start to make a profit in order to apply the loss against in order to reduce your tax liability. Before we come to a close, I must mention that there will be an administrative burden that needs to be considered if you decide to incorporate. There are startup costs associated with incorporating that you need to be aware of. If you decide to incorporate yourself, just going online, then you can do it for $300 to $400. If you have a simple business, you can use online resources like Law Depot to assist in the process. We generally recommend this for individuals who have a simple business with a relatively simple share structure. Another way to do it is to go through a lawyer and discuss in detail your share structure along with specific particulars that you may be concerned about. This will cost anywhere from $1,000 to $2,000 depending on the law firm. In the event that you're not the sole owner and there are other shareholders involved, then you will also want to have a shareholder agreement. We always recommend that you have one of these agreements in place, as it will save you from a lot of potential issues and headaches in the future. The cost of this could be $1,000 to $2,000 as well. However, it's definitely worth it in the long run. And each year you will have to file your annual report with the corporate registry, and that's going to cost you about $50 if you do it yourself and about $300 if you have your lawyer take care of it. One of the most important administrative responsibilities that you can't overlook is the year-end corporate tax filing. You will be required to file a T2 tax return for your corporation, along with a T1 personal tax return for yourself. You can definitely file your T2 on your own, however, we recommend that you hire a bookkeeper and accountant that can take care of that for you. If you pay yourself from your corporation as a dividend, then you will need a T5 slip. Whereas if you're on payroll and paid a salary, then you will need to generate a T4. I hope this video has helped provide you with critical information that will aid in weighing the pros and cons of being incorporated versus sole proprietorship and vice versa. Thanks for watching. Before you go, answer this. What's your situation? Are you in limbo deciding between sole proprietorship and incorporation? Tell us in the comments and we're all ears, ready to help. And like always, if you found this video helpful, please like, share, and subscribe to our channel for more insightful content. Until next time, stay financially savvy.